October 19th, 1987, proved computers could crash markets faster than humans ever imagined. But within 2 years, stocks recovered fully. The Fed had discovered the perfect rescue playbook. Wall Street assumes it still works. Picture this. You wake up Monday morning, October 19th, 1987. Your coffee's brewing, the newspaper hits your driveway, and you're thinking about another ordinary trading day. By market close, you've witnessed the single largest stock market crash in American history. The Dow Jones plummeted 22.6% in one day. Not 1 week, not 1 month. One day. To put this in perspective, that 22.6% drop nearly doubled the worst day of the infamous 1929 crash, which fell 12.8%. Think about that for a moment. The crash that triggered the Great Depression looked like a gentle correction compared to what happened on Black Monday. But here's where the story gets interesting. While investors panicked and financial experts predicted economic catastrophe, something unprecedented happened. The Federal Reserve stepped in with a rescue so swift and decisive that it created a playbook Wall Street has relied on for the next 4 decades. Let's rewind to understand how we got to that Monday morning. Throughout the early 1980s, our stock market had been on an absolute tear. Since 1982, stock prices had tripled without any meaningful correction. Think about your investment portfolio tripling in 5 years with barely a hiccup. It felt like free money, and everyone wanted in. The party atmosphere on Wall Street was infectious. Traders threw around terms like new paradigm and permanently high plateau. Sound familiar? These are the same phrases we heard before every major crash in our financial history. But in 1987, most investors genuinely believed this time was different. Then reality started creeping in during the autumn of 1987. The Federal Reserve began raising interest rates to combat what they saw as dangerous twin deficits and rising inflation fears. When the Fed raises rates, it's like turning up the pressure valve on an overheated market. Something has to give. The first crack appeared on Friday, October 16th. This wasn't just any Friday, it was what traders call a triple witching day. Stock options, futures contracts, and index contracts all expired simultaneously, creating extreme volatility as massive trades unwound at once. The market dropped significantly, but most investors figured it was just end-of-week turbulence. That weekend changed everything. No major news broke, no disasters struck. No, companies collapsed. But investors had time to think, and what they realized was terrifying. Stock valuations had become completely detached from reality. Price-to-earnings ratios had reached levels that made no fundamental sense. Picture thousands of investors across the country spending their weekend doing the same calculation, looking at their portfolios, running the numbers, coming to the same conclusion. These prices couldn't be sustained. Monday morning arrived like a financial tsunami. Before the markets even opened, sell orders had overwhelmed the system. Investors weren't just nervous, they were desperate to get out. But here's where the real chaos began. Wall Street had fallen in love with a new technology called portfolio insurance. These were computerized systems designed to protect investors against market declines. The concept seemed brilliant. When stock prices hit certain loss thresholds, computers would automatically sell positions to limit damage. What could go wrong? Everything. As stocks began falling Monday morning, these computer systems triggered massive automated selling. But here's the deadly spiral. As the computers sold more stocks, prices dropped further, which triggered even more automated selling. Human oversight had been removed from the equation. Algorithms were selling to other algorithms in an endless feedback loop. Index arbitrage trading added gasoline to this fire. Computers simultaneously sold futures contracts while dumping stocks, accelerating the downward spiral beyond anything human traders had ever experienced. The system had created a self-reinforcing crash with no natural bottom. By mid-morning, panic had set in across trading floors. Veteran traders who had survived decades of market ups and downs stood frozen, watching numbers they'd never imagined. The Dow wasn't just falling, it was plummeting at a rate that defied comprehension. The carnage wasn't limited to our markets. This was the first truly global financial crisis of the computer age. Hong Kong's market collapsed 45.8%. Australia dropped 41.8%. The United Kingdom fell 26.4%. The crash was cascading worldwide as Asian markets opened to the reality of what had happened in America. Think about the human drama unfolding in those hours. Retirement accounts that had taken decades to build vanished in minutes. College funds disappeared. Investment portfolios that represented families' entire life savings were cut in half before lunch. But here's what makes the 1987 crash truly remarkable. It wasn't just the speed of the fall, it was the speed of the recovery. Within 2 years, the market had not only recovered, but reached new highs. This seemingly impossible turnaround happened because of what the Federal Reserve did the morning after Black Monday. At 7 a.m. on October 20th, Fed Chairman Alan Greenspan issued a single sentence that would reshape American finance for the next 4 decades. The Federal Reserve affirms its readiness to serve as a source of liquidity. That's it. One sentence. But those 13 words contained a promise that investors would never forget. Greenspan had been Fed chairman for just 69 days when the crash hit. He was the new guy facing the biggest financial crisis since the Great Depression. But his response was swift, massive, and brilliant. The Fed immediately injected $17 billion into our banking system, equivalent to 25% of total bank reserves at the time. To understand the scale of this intervention, imagine the Fed today announcing they're injecting 7% of our nation's entire monetary base in a single day. That's the equivalent firepower Greenspan unleashed. Federal funds rates dropped half a percentage point instantly. The Fed started their market operations an hour early each day, publicly signaling the urgency of their response. The strategy worked flawlessly. Markets rallied 200 points immediately after Greenspan's statement, and while they collapsed again by noon, investors had gotten the message. The Federal Reserve would not let the financial system collapse. They had unlimited ammunition and the will to use it. This is where our story takes a crucial turn. The 1987 rescue wasn't just successful. It was so successful that it created what economists now call the Greenspan Put. Just like a put option provides downside insurance for stock investors, the Fed had essentially provided downside insurance for the entire market. For the next 40 years, from 1987 to 2027, American investors learned a simple lesson. When markets crash, the Fed will rescue them. Buy every dip. Trust the system. The cavalry will always come. This lesson was reinforced repeatedly. When the dot-com bubble burst in 2000, the Fed cut rates aggressively. When the 2008 financial crisis threatened global collapse, they invented quantitative easing. When COVID crashed markets in 2020, they printed money on an unprecedented scale. Each rescue reinforced the same belief. The Fed won't let markets truly crash. The 1987 Playbook became the foundation of every investment strategy, every retirement plan, every portfolio allocation in America. But what if I told you that playbook is about to fail spectacularly? What if the very success of the 1987 rescue created conditions that make it impossible to repeat? What if 40 years of Fed backstops have built a financial system so dependent on rescue that it can't survive without one, but the tools required for rescue no longer exist? The story of October 19th, 1987 isn't just history. It's the blueprint for what millions of investors expect will happen during the next major crash. They're counting on circuit breakers to pause the selling. They're expecting Fed statements to restore confidence. They're waiting for the liquidity tsunami that saved markets 40 years ago. But the ammunition that made the 1987 rescue possible has been spent. The debt levels, inflation pressures, and exhausted Fed balance sheet that define our current reality didn't exist in 1987. The playbook that created 40 years of market confidence is about to meet economic conditions that render it useless. The greatest trick Wall Street ever played was convincing investors that 1987 was proof the Fed would always rescue markets. The greatest tragedy is that this belief became so embedded in our financial system that questioning it feels impossible. Until now. October 20th, 1987, 7 a.m. Alan Greenspan had been Federal Reserve Chairman for exactly 69 days when he faced the biggest financial crisis since the Great Depression. His response didn't just save the markets, it rewired the DNA of American capitalism for the next 4 decades. That single sentence Greenspan released wasn't accidental. The Federal Reserve affirms its readiness to serve as a source of liquidity. Every word was carefully chosen. He didn't promise specific actions. He didn't commit to exact amounts. He simply signaled that the full power of the Federal Reserve stood ready to flood the system with money. The market's initial reaction was electric. Stocks rallied 200 points immediately after his statement hit the wires. Trading floors erupted with cheers. But then something interesting happened. By noon, markets had collapsed again. The rally evaporated as quickly as it had appeared. This is where most people think the Greenspan rescue failed. They're wrong. The temporary collapse was exactly what Greenspan expected. He knew words alone wouldn't solve the crisis, but words would buy him time to deploy the real weapon, a liquidity tsunami unlike anything Wall Street had ever seen. What happened next changed everything. The Fed didn't just inject money into the banking system, they unleashed a coordinated assault on the crisis that demonstrated the true power of central banking. On October 20th alone, they pumped $17 billion into our financial system through open market purchases. Let me put that number in perspective for you. $17 billion represented 25% of total bank reserves in the entire United States. It was 7% of our nation's entire monetary base, deployed in a single day. Imagine the Fed today announcing they're injecting $1.2 trillion into the system overnight. That's the equivalent scale of what Greenspan authorized. But the raw numbers only tell part of the story. The Fed's response was strategically brilliant in ways that most people never understood. They didn't just throw money at the problem. They engineered a psychological transformation in how markets viewed central bank intervention. First, they cut the federal funds rate by 0.5 percentage point instantly. Remember, rates were at 7.5% before the crash, giving them enormous room to maneuver. This wasn't a cautious quarter-point adjustment. This was shock and awe monetary policy. Second, they started their daily market operations an hour earlier than usual, sending a visible signal of urgency to every trader on Wall Street. When the Fed changes their routine, smart money pays attention. This wasn't business as usual. This was crisis response mode. Third, they continued these massive interventions for weeks, not days. Every morning, traders woke up knowing the Fed was actively working to stabilize markets. The psychological impact was as important as the monetary impact. But here's what made the 1987 rescue truly remarkable. The economic conditions were perfect for this strategy to work. And I mean perfect in ways that will never exist again. Our national debt in 1987 was $2.4 trillion. Sounds like a lot. But relative to our economy, it represented just 50% of GDP. When the Fed injected that $17 billion in liquidity, it was a tiny fraction of total debt. The inflationary impact was negligible because there simply wasn't enough debt in the system to amplify the monetary expansion. Think about this carefully. The Fed could print money aggressively because our debt burden was manageable. They could cut rates dramatically because inflation was actually falling throughout 1987. They had monetary policy ammunition that was fully loaded and ready to fire. The market structure also worked in their favor. The 1987 crash was fundamentally a technical event caused by computerized program trading, not a reflection of underlying economic weakness. The real economy was strong, corporate earnings were solid, employment was stable. The crash was essentially a software malfunction that had gotten out of control. This is crucial to understand. Greenspan wasn't trying to rescue a failing economy. He was trying to restore confidence in a healthy economy that had suffered a technical glitch. The fundamentals supported his intervention. The results were stunning. By 1989, just 2 years after Black Monday, the stock market had not only recovered, but reached new all-time highs. Investors who held through the crash were rewarded handsomely. Those who panicked and sold at the bottom learned a painful lesson about Fed rescue power. But the most important result wasn't the market recovery. It was the birth of what economists call the Greenspan Put. This concept became the foundation of modern American finance, and understanding it is essential to grasping why our current system is so fragile. A put option gives investors the right to sell stocks at a predetermined price, providing downside protection. The Greenspan Put was the market's belief that the Federal Reserve would provide similar downside protection for the entire market. If stocks fell too far, the Fed would intervene. This wasn't just theory, it became observable reality. For the next 40 years, every major market decline was met with Fed intervention. The 1990 recession brought rate cuts. The 1998 long-term capital management crisis triggered emergency liquidity. The 2000 dot-com crash led to aggressive easing. The 2008 financial crisis produced quantitative easing. The 2020 COVID panic resulted in unlimited money printing. Each rescue reinforced the same lesson. The Fed will not let markets truly crash. Investors learned to buy every dip because they knew the cavalry was coming. Financial advisors built portfolios assuming Fed backstops. Retirement plans were structured around the belief that major market declines would be temporary. The Greenspan Put became so embedded in our financial DNA that questioning it felt almost heretical. Portfolio managers who didn't buy dips were fired. Investment strategies that hedged against prolonged declines were ridiculed. The entire American financial system evolved around the assumption that Fed rescue was guaranteed. But here's where the story gets dangerous. While the Fed was busy rescuing markets, they were also creating the conditions that would make future rescues impossible. Every intervention increased our debt burden. Every round of money printing reduced their future ammunition. Every rate cut brought us closer to the zero bound. Most importantly, each rescue created moral hazard on an unprecedented scale. Investors took bigger risks because they knew the Fed would bail them out. Companies borrowed more money because rates were artificially low. Asset prices inflated beyond any reasonable valuation because Fed policy supported speculation. The regulatory response to 1987 completely missed this point. In October 1988, exactly 1 year after Black Monday, regulators implemented circuit breakers that would halt trading when the Dow dropped 250 or 400 points. The goal was to give investors time to process information and prevent panic selling. These circuit breakers were pure theater. They addressed the symptom of the 1987 crash, rapid selling, while ignoring the cause, computerized program trading, and overvaluation. More importantly, they reinforced the wrong lesson about what had actually saved the markets. It wasn't circuit breakers that stopped the 1987 crash, it was Fed liquidity. The trading halts were cosmetic changes designed to make regulators look responsive. The real power lay in central bank intervention, and everyone on Wall Street knew it. The circuit breaker system has been updated multiple times since 1988, but the fundamental concept remains the same. Pause trading to let emotions cool down. During the 2020 COVID crash, these circuit breakers triggered 4 times in 10 days. Did they stop the crash? Absolutely not. Markets resumed falling every time trading reopened. What stopped the 2020 crash wasn't circuit breakers. It was the Fed announcing unlimited quantitative easing and congressional approval of massive fiscal stimulus. Once again, the 1987 playbook saved the day. Print money, restore confidence, watch markets recover. But each rescue came at a higher cost. The 2008 intervention required unprecedented balance sheet expansion. The 2020 rescue pushed money printing to levels that would have been unthinkable in previous decades. The ammunition required for each rescue kept growing, while the Fed's capacity to provide it kept shrinking. By 2024, the Greenspan Put had become the most expensive insurance policy in human history. The Federal Reserve's balance sheet had expanded from $800 billion in 2007 to over $7 trillion by 2022. Interest rates had been held near zero for most of the 2000s. Federal debt had exploded from manageable levels to over 120% of GDP. Yet investors continued to price in Fed rescue as if nothing had changed. Portfolio allocation models still assumed temporary downturns. Risk management systems still relied on central bank intervention. The entire edifice of American finance remained built on the foundation of 1987's success. What these investors failed to realize was that the 1987 rescue was successful precisely because the Fed had unlimited ammunition, low debt, manageable inflation, high interest rates, and a clean balance sheet gave Greenspan every tool he needed. The rescue worked because the conditions were perfect for it to work. By 2026, Every single one of those conditions has been reversed. The debt that made money printing safe in 1987 has exploded to levels that make it dangerous. The inflation that was falling in 1987 remains persistently elevated. The interest rates that gave Greenspan cutting room have been exhausted by previous rescues. The clean Fed balance sheet has been bloated by decades of intervention. The greatest irony of the Greenspan Put is that its very success guaranteed its eventual failure. 40 years of rescues created the debt, inflation, and monetary exhaustion that make future rescues impossible. The playbook that worked in 1987 planted the seeds of its own destruction. But Wall Street hasn't figured this out yet. They're still waiting for the next rescue, still buying every dip, still assuming the Fed will save them. They're about to learn that the most dangerous phrase in finance is, "This time is the same." The 1987 playbook requires 4 essential tools: the ability to inject massive liquidity, room to cut interest rates dramatically, circuit breakers to pause panic selling, and Fed credibility to restore confidence. In 2026, every single one of these tools is either broken or depleted. Let me show you exactly why. Start with the liquidity weapon that saved 1987. When Greenspan injected $17 billion into our banking system, it represented just 0.7% of our total national debt. The inflationary impact was negligible because the debt base was small enough to absorb the monetary expansion without consequences. Fast forward to 2026. Our national debt has exploded from $2.4 trillion to over $36 trillion. If the Fed attempted an equivalent intervention today, they would need to inject more than $250 billion in a single day. But here's the problem. That much money hitting a debt base 15 times larger would trigger immediate inflation acceleration. Think about the mathematics for a moment. In 1987, our debt-to-GDP ratio was a manageable 50%. Today, it's 123%, literally double the burden relative to our economy's size. When you inject liquidity into a heavily indebted system, you don't get the same economic stimulus. You get asset bubbles and price inflation. The Fed learned this lesson painfully during 2021 and 2022. Their COVID money printing, combined with our massive debt load, produced the worst inflation in 40 years. They called it transitory until it became undeniably permanent. That inflation forced them to raise rates aggressively, setting up the very conditions that make the next crisis unsolvable. But the debt prison goes deeper than just inflation risk. The Federal Reserve's own balance sheet has been bloated from $800 billion in 2007 to over $7 trillion by 2022. They've already used the quantitative easing ammunition that was supposed to be reserved for emergencies. Their expansion room is essentially exhausted. When the next crisis hits and the Fed tries to inject liquidity, they'll face an impossible choice: print money and trigger a currency crisis as inflation accelerates beyond control, or refuse to print and watch markets collapse without rescue. Either way, the liquidity tsunami that saved 1987 can't be repeated. Now, let's examine the interest rate ammunition that gave Greenspan his cutting power. In 1987, the federal funds rate stood at 7.5%, giving the Fed 750 basis points of room to cut all the way to zero. That's enormous firepower for economic stimulus. Today, rates sit around 4.0 to 4.25%, providing only 400 basis points to zero. But here's the cruel irony. The Fed can't even use that limited ammunition aggressively because inflation remains elevated. Core PCE inflation is still running at 2.5 to 3.0%, well above the Fed's target. Every rate cut in our current environment costs the Treasury approximately $360 billion in additional debt service payments. With our deficit already exceeding $1 trillion annually, aggressive rate cuts would worsen the fiscal crisis that's driving the market panic in the first place. Remember, Greenspan could cut rates in 1987 because inflation was falling throughout that year. The economic environment supported monetary easing. Today's Fed faces the opposite situation: persistent inflation that punishes any attempt at aggressive stimulus. Even if they wanted to cut rates to zero tomorrow, the inflationary consequences would force them to reverse course within months. They're trapped in a box created by decades of previous interventions. The circuit breaker system that regulators installed after 1987 provides another perfect example of tools that worked then but fail now. The original circuit breakers were designed to halt trading when the Dow dropped 250 to 400 points, representing roughly 12 to 20% declines in 1988. Fast forward to today. The Dow trades above 43,000. Those same percentage drops would require 5,160 to 8,600 point declines before circuit breakers activate. The mathematical scaling makes the system far less responsive to equivalent market stress. But the real problem with circuit breakers isn't mathematical, it's structural. Modern market complexity makes 1987's program trading look like child's play. We now have exchange-traded funds, options markets, algorithmic trading, and leverage instruments that are hundreds of times more sophisticated than anything that existed in 1987. Circuit breakers pause trading, but they don't address the underlying solvency issues driving the selling. When markets reopen after a halt, the fundamental problems remain unchanged. If anything, the pause gives investors more time to calculate just how overvalued assets have become. The 2020 COVID crash proved this point definitively. Circuit breakers triggered 4 times in 10 days, halting trading at 7, 13, and 20% declines. Did they stop the crash? Markets resumed falling immediately upon reopening each time. What stopped the crash wasn't circuit breakers. It was the Fed's promise of unlimited money printing. Which brings us to the most important broken tool: Federal Reserve credibility. In 1987, when Greenspan issued his famous liquidity statement, markets believed him instantly because Fed credibility was intact. Central bankers were trusted to do what they promised. That credibility has been systematically destroyed by the transitory inflation debacle of 2021 to 2022. Fed Chairman Jerome Powell repeatedly promised that COVID-era inflation would prove temporary, even as prices surged month after month. He maintained this position until it became laughably obvious that inflation was accelerating, not cooling. The damage to Fed credibility can't be overstated. When Powell finally acknowledged that inflation wasn't transitory, he essentially admitted that the Federal Reserve either didn't understand the economy or deliberately misled the public. Either explanation destroys the confidence required for crisis intervention. Studies show that Fed forward guidance effectiveness has declined by approximately 75% since 2020. When central bankers speak, markets no longer automatically believe them. They demand proof, not promises. But in 2026, the Fed won't be able to provide the proof investors require. This credibility gap creates a vicious cycle. When the next crisis hits and the Fed issues rescue statements, markets will demand immediate action to back up the words. But the fiscal constraints, inflation risks, and depleted ammunition make immediate action impossible. The delay between promise and delivery will amplify panic instead of calming it. The recovery timeline that made 1987's rescue look successful also no longer exists. Greenspan's intervention worked because the underlying economy was fundamentally strong. Corporate balance sheets were healthy. Consumer debt was manageable. The crash was a technical malfunction, not a reflection of deeper problems. The 2026 crisis will occur against a backdrop of structural weakness that didn't exist in 1987. Corporate debt has reached record levels during years of artificially low interest rates. Consumer savings have been depleted by 3 years of inflation, eating away purchasing power. Commercial real estate faces a solvency crisis as remote work permanently reduces office demand. Regional banks remain fragile from 2023's mini-crisis, holding hundreds of billions in underwater treasury bonds and commercial real estate loans. Geopolitical instability adds another layer of uncertainty that makes confident investment impossible. Most importantly, the federal government itself faces a debt crisis that compounds every other problem. Interest payments on our national debt now consume over $600 billion annually, more than we spend on defense. Every percentage point increase in rates adds $360 billion to our deficit. This creates an impossible situation. The fiscal crisis that triggers the market crash can't be solved by the same monetary tools that would normally rescue markets. It's like trying to put out a fire with gasoline. When the 2026 crash begins, here's exactly what will happen. Phase 1. Markets drop 15 to 20% as investors hit their stop-loss levels and algorithmic selling accelerates. Phase 2. Investors expect the traditional Fed rescue announcement, just like every crisis since 1987. Phase 3. The Fed issues supportive statements, but can't back them with aggressive rate cuts due to inflation concerns or massive liquidity injection due to debt constraints. Phase 4. Circuit breakers pause trading as selling intensifies, but markets resume falling when trading reopens because the fundamental problems remain unsolved. Phase 5. Investors realize the Fed put is gone. The 40-year assumption that central banks will rescue markets breaks down completely. Phase 6. Markets experience a 30 to 50% decline as asset prices reprice without Fed support for the first time since 1987. The final phase will be the most devastating. Recovery takes a decade instead of 2 years because the structural problems that caused the crash can't be solved by monetary policy. The debt burden remains. The inflation sensitivity persists. The fiscal crisis deepens. This is the crucial difference between 1987 and 2026. The 1987 crash was a technical correction with rescue available. The 2026 crash will be an overvaluation meeting a depleted central bank. In 1987, short-term traders lost money, but long-term holders recovered quickly. In 2026, everyone loses. 401k accounts, pension funds, retirement savings, because the Fed simply can't print a rescue. The most tragic aspect of this coming crisis is that it's entirely predictable. The tools that made 1987's rescue possible have been systematically depleted by 40 years of interventions. Each rescue made the next one more expensive and less effective. We've reached the mathematical end of central bank omnipotence, but Wall Street continues operating as if nothing has changed. Portfolio managers still buy every dip expecting Fed rescue. Risk models still assume temporary downturns. Retirement planning still relies on central bank backstops. The entire American financial system remains structured around assumptions that are about to be shattered. October 19, 1987, taught investors that the Fed would always rescue markets. That lesson created 40 years of Greenspan Put dependency that now defines every portfolio on Earth. In 2026, when markets drop and investors wait for the rescue, they'll discover that the playbook requires ammunition the Fed no longer has. Circuit breakers will pause trading just like they're designed to. Fed statements will promise support just like they always do. But the debt levels, inflation constraints, and exhausted balance sheet mean the liquidity tsunami can't come. The 1987 playbook doesn't fail because it's outdated. It fails because the tools it requires no longer exist. The greatest financial lesson of our lifetime is about to be written. For 40 years, we've lived in a world where markets couldn't truly crash because the Fed wouldn't let them. That world is ending, and most investors have no idea what comes next.